morning, everyone, and welcome to Origin's bi-monthly series where we educate our clients and industry colleagues on the aspects of real estate investing. My name is David Scherer, and I'm co-founder and co-CEO of Origin Investments. I'm super excited this morning. I'm joined by Joe Pagliari, clinical professor of real estate at the University of Chicago Booth School of Business. Joe's been within real estate for over 35 years. And his research attempts to answer important questions. I'm going to name a few because the intro will be quite long if I don't, but some of the work that Joe's done in the past are papers on a comparison of REITs to private real estate, real estate's role in a mixed asset portfolio, the strategic use of leverage in real estate. And accordingly, Joe has co-authored numerous papers and presented these papers. And many of the places you'll recognize, NACREIF, NAREIM, PREA, ULI. Joe also presented to the Federal Reserve Bank, as well as the House of Representatives. And he's been published numerous times, including in Barron's and the Wall Street Journal. Joe recently, in 2015, I suppose that's not that recent, Joe, was presented the James A. Groskamp Award, which recognizes those who have, through significant research, contributed practical insights to the common body of knowledge. Joe earned his bachelor degree at UIC right here in Chicago. He earned his MBA also in Chicago at DePaul. My business partner, Michael, is a double DePaul grad, so he'll be happy to hear that. And his PhD was earned at UIC as well. So I'm going to give you a little roadmap because we have quite a bit to cover today. And there's been many questions that were sent in before. So for the next 15 minutes, I'll start with a brief description of Origin, very brief. Then I'm going to go into an article that I wrote. Each year I write an article naming 10 real estate trends. It's a predictive article that comes out in December, January. And then I grade that the following December and rewrite a new one. I'm going to go over 4 of the 10 trends. If you're interested in reading the article, you can, or we can cover the other 6. There's just not time today. Then Joe is going to expand on one of these topics. He's done a lot of quantitative work on gateway markets, and I'm not going to steal his thunder. So he'll take you through what that research has shown. And then we want to leave at least 20 minutes for questions. 48 questions were emailed in prior. We're not going to be able to get to all of those, but we certainly will cover a lot. And then we also want to take some live questions. So please go to your Q&A feature. I know that everyone is highly Zoom proficient at this point. And so we'll also take some live questions. You won't be able to ask them, but I'll see them and I will read the question and then either Joe or I will answer. Lastly, if you sent us your email, we plan to email you the full presentation, as well as Joe's appendix in true professorial form. Joe sent me, I want to say it's a 15-page PowerPoint with enough data for a semester. I had some flashbacks to my own days as a Booth student when I saw his initial, but that'll show up in the appendix for those who want to see it. So with that, Claire, could you please open the PowerPoint to the second slide? So that's us, we're the hosts. Let's go on to the brief slide about Origin. Terrific. So Origin Investments, we invest in multifamily, and those are all the cities that we invest in. When I describe Origin, we invest in the Southeast, Texas, and the Southwest. Chicago's our hub. We have traditionally invested here too. We're not investing here going forward. And so maybe we'll cover that in the Q&A, or Jill will cover some of it. In terms of transactions, we've executed $2 billion in transactions. We currently have $2 billion of assets at the firm and over $500 million of equity. We have 1,400 investment partners, and that means active investment partners in our 5 funds that all focus primarily or exclusively on multifamily. And then a little bit about, we're very proud that we've never had a loss on any deal that exceeds 50 deals at this point. And our average gross IRR has been 33%. Admittedly, we started 10 years ago and it's been a good market. I'm more proud that we've outperformed our peers who are also multifamily managers. We're a top decile manager, so that's more of a comparative analysis than an absolute. And then lastly, it's not on this slide, but we have a core belief in alignment. And so my partner, Michael, and I remain our largest investors at the company. So we're among those 1,400 investors. Next slide. Okay, so this is my article, and I'm going to be very brief. I want you to stop me in 8 minutes, Claire, no matter where I am. Okay, that's your job. And I'm going to. Okay, so the first prediction I made in the article for 2021 was an exodus from gateways, and I include Chicago as a gateway. Typically, gateways are LA, Boston, DC to some extent, certainly New York City, but I'm going to throw Chicago in as well. It's not as much of international, but it's certainly a big city. So first of all, demos over the last 10 years out of New York City, LA, and Chicago are a real thing. So this is sort of an easy prediction to make because in a world of inertia matters. So like, in other words, if people are leaving a city 5 years ago, 4 years ago, 3 years ago, it takes something exogenous to stop that, right? Or it'll just continue, like objects in motion tend to stay in motion. So I'm just predicting that it's going to continue. And so let's go into the why. I think that probably the biggest single reason is there's a movement of people from high cost, high tax states into lower cost, lower tax states. And then of course, business also is looking at the same thing. So both labor and businesses are making that decision. LA would be a great example. A tremendous amount of growth in Phoenix and Denver are simply people leaving California. A tremendous amount of growth in Charlotte are people leaving New York City. A tremendous amount of growth in Nashville and Texas are people leaving Chicago. And I'm generalizing, I mean, they move all over, but Nashville is an hour and a half plane trip from Chicago. It's a centralized city that is getting bigger and bigger and competing more and more. So like for the folks that were wondering what Midwest city could possibly compete, maybe it's Nashville, right? Maybe, people group it in the South, but get on a plane and figure out how easy you get there. The other is weather and lifestyle. Data is great. We're very, very data driven. I know Joe is. But sometimes you just need to talk to people too. So the next time you talk to someone who is moving to Denver or Austin or Charlotte, a lot of times they have jobs and a lot of times they just want to live there. And they want to enjoy that lifestyle of more sun, warmer weather, more to do outside. And then when you pair that with lower cost, it becomes pretty powerful. The exodus from the gateways in Chicago was exacerbated by the tax bill of 2017 because it no longer, prior to that, you had an unlimited deduction for taxes and interest on high-end homes. And so in these very high cost states and cities, that made it even more expensive to maintain that, multi-million-dollar home in New York City. All of a sudden, you couldn't write off the taxes above, I believe it was $10,000 at that point. And then lastly, COVID. So COVID, I talked about earlier, needing a shock to stop the exodus. And instead, what you got was a shock to increase the exodus. And so when COVID hit, with the rise of virtual work, and importantly, employers realizing that the virtual work was just as efficient. There are concerns about maintaining culture. for sure, when you have a virtual workforce. But generally, the productivity in many industries hasn't dropped. I'll use Origin as an example. We have 30 people at Origin, many of which were already in our regional offices across the country, but the bulk were in Chicago. And when we went virtual, the whole firm did, and we've operated at a very high level. We haven't lost anything in terms of efficiency. We have had to make big strides in maintaining culture, so virtual cultural events, or how we did that. And then along the way, some of our labor has asked, and we've said yes. They wanted to move from Chicago to Tampa Bay and Austin. These are both cities we cover, and they're now working there. And so, like, you know, unfortunately for the gateways in Chicago, the exogenous shock was to increase the exodus. And that's the rise of virtual labor, providing more flexibility to the labor force. Lastly, remember, when you're doing the equation and you live in New York City or Chicago, part of that equation is you're saying it's more expensive to live here, but look at all the things I get. I get the arts, better restaurants, I get transit, great universities. Every year that spread erodes. Do you think that the people moving to Charlotte and Denver and Austin and Nashville don't want good restaurants? You don't think that they want good arts? You don't think that they don't want transit? Charlotte and Denver have light rail now. They're cleaner and newer than Chicago's or New York City's. So all of this is happening and quickening the pace of exit. And it has to be stopped by something else. I'm going to move on because Claire, I have 2 minutes now. Move me back to 11:20. Thank you. All right, so number 2, I'm going to go faster. Demand for office space remains weak. Again, I covered remote. It's working. There isn't a stigma. It's a much cheaper model for employers, and it's a much more convenient model for labor. And so you basically have both sides of the equation doing it. Zoom and Microsoft will continue to improve. Others too. Cisco system has an offerings and others. But they're going to continue to improve. Classic disruption starts with an inferior product, and it gets better and better each year. You know, Clayton Christensen wrote about it. That's what Zoom and Microsoft are. They're going to continue to improve the premium product of physical office space. And by the way, I don't know if Joe wants to speak to this later in Q&A, but universities have the same problem. They're long physical assets, and they want to charge a premium for in-place education. There's going to be real pressure. I mean, this isn't going away. So my point on office demand is this is a change in the demand curve. The pandemic will end. It's going to end sooner than we think. But I believe the demand curve is not ever going to return to peak because there's a new entrant that's satisfying demand virtually. And that affects valuations because that's a long-term change. And I'm moving on, doing better, Claire. Urban and suburban multi-valuations will go higher. So this is going to be fueled and is being fueled. I'm cheating a little bit here because valuations are already higher. Valuations in multifamily in the non-gateway markets, the markets Origin covers, Texas, Southeast, Southwest, are 5 to 7% higher than pre-COVID. And that's kind of a shocking statement if you think about it. I can tell you NOIs are lower. I can tell you that my collections are lower. We can't evict people right now. So when people don't pay rent, I can't evict them. And so we have to deal with that. So why are valuations higher? 2 reasons. One, debt is unbelievably cheap. And by the way, when I say cheap, I mean cheap for multifamily. If you're a hotel operator and you're trying to get a loan, it's not cheap, right? But what's happened is there used to be 5 real estate asset classes that were lendable, and now there's really 2. It's multifamily and it's industrial, and to some extent, certainly lendable is the entire virtual realm, which is data centers, towers, things like that, highly lendable. But of the main traditional food groups, you're down to 2. So lenders still want to lend money, they have to put out, but their opportunity set is tiny. And so now I can borrow at 3% routinely, and cap rates were 4. Pre-pandemic, I was borrowing at 4%, and cap rates were 4.25. And so that's producing way more levered yield to equity and driving valuations. And then the last thing is that same equation applies to equity itself. There's records amount of equity that's been raised, and they used to have a lot of asset classes in real estate to invest in. It's the same as lenders. They don't want to invest in many asset classes. So I can tell you, like, for example, we're selling a deal right now that our third fund owns in Denver. We had 50 CAs signed, confidentiality agreements. We've had over 25 tours. There's no question in my mind that it'll trade 5 to 8% above the high end of range. And that's what's happening right now with, highly sought after multifamily assets. Number 4, I have 2 minutes. Great segue into Joe's work. Affordability will continue to drive outsized growth in multifamily operations and valuations in the suburbs. And this is something that really started even pre-pandemic, but it was accelerated as people wanted more space because they were working from home, and also more outdoor space and less density and less exposure to elevators. And but what was happening even in 2018 and 2019, and it really informed the way that Origin was positioning our portfolios, is the affordability in urban centers, in particular in gateway markets. Again, we're not in gateway markets, but in some of the markets we were in, Austin, Nashville, Denver, the dense part of the cities, the highly sought after parts in those years, were getting priced out from an affordability standpoint. And it's not sustainable. It's not sustainable when you're paying 35% or 40% of your income for rent. That's not a sustainable place. And so what we found, we have machine learning tools at Origin that we constantly are feeding data into, and it helps us in our predictive analytics. And what we found is when we regress out variables, affordability is the strongest variable, not only in market selection itself, i.e. picking a city, but also in sub-market selection within a city. And so with that, I'm going to turn it over to Joe, and he's going to give a deep dive into his gateway market analysis. And I bet that somewhere in that analysis, affordability will come up.
Thank you, Dave. Pleasure to be with you all today. I want to talk a little bit about gateway versus non-gateway markets and whether or not the gateway markets are mispriced. So Claire, if you could advance to the next slide, please. I want to start with this issue of pricing. So at least up to the pandemic, I would say that the conventional wisdom amongst institutional investors is, and still holds to some degree today, that the gateway markets offer more liquidity, which is definitely true than the non-gateway markets. They offer higher expected growth rates with regard to cash flows in the future, and they are less risky. Amongst the arguments is that they are markets in which it's difficult to add to the supply of existing buildings. So as Dave mentioned before, there are many definitions of gateway versus non-gateway. I'll sort of hew to the Real Capital Analytics definition, which is the tier 1 or gateway markets are Boston, New York, DC, Chicago, LA, and San Francisco. And I'll show you a list of the tier 2 and tier 3 markets as I think of them, at least. But when you think about tier 2 markets, think about places like Atlanta, Dallas, Houston, Miami, Phoenix, San Diego, Seattle. Tier 3 is within reason everything else, everywhere else where institutional investors place capital. And you can see that at the end of 2019, there was about a 50 basis point premium, if you will, for being in the gateway markets versus the tier 2 markets, and another 60 or 70 so basis points with regard to tier 3 markets, right? So in general, there's about 100 basis point differential between the gateway markets and the non-gateway markets with regard to their pricing. And I want to push back on the conventional wisdom. I want to do so before the pandemic started. I totally take Dave's point about the pandemic has basically been a grand large-scale experiment with regard to work from home issues, technology and all the rest, and it's proven more times than not to be successful. But what I want to argue is that before the pandemic, there were significant headwinds facing these gateway cities that the non-gateway cities don't face to the same degree. So I've identified 5 of these factors. And Claire, if you could advance to the next slide. The first one is, perhaps no surprise to many of you, the financial solvency of a given state, county, or city. So this is just a simple map that looks at state by state solvency, the balance sheet, as Dave referred to it before, of each of these states. And you can see that of the 9 worst ranked states, 6 of them are markets or states containing the so-called gateway markets. And my issue with financial or fiscal solvency is not only that it's an immediate financial problem, but it also crowds out expenditures on things like schooling, policing, infrastructure, cultural events, transportation, and all the rest. And I would lastly argue with regard to fiscal conditions that those states that are and cities that are operating from a position of strength as opposed to a position of weakness find themselves generally making far better decisions than those that are weakly financed. So Claire, if you could go to the next slide, please. Just to follow up on that, and this also should be not a surprise to many of you, at least of those of you familiar with Chicago, that is to say that the lion's share of the fiscal problems relating to these cities, counties, and states relates to unfunded or underfunded pension plan liabilities to public sector employees. And we could have a political conversation about whether those benefit schemes are good or bad. Doesn't really matter. As a fiduciary, the question you have to ask yourself is, what are these underfunded liabilities likely to mean for the future of these real estate markets? And I would argue without some kind of curing mechanism for these underfunded public sector pension plans, these cities and states are going to continue to have all sorts of challenges. As an aside, I should also point out that when it comes to the accounting of these liabilities, these pension fund liabilities, it's a very Byzantine world full of all sorts of assumptions, some of them dubious. And so there's lots of related discussion as to what the true financial liability is. Next slide, please. So think about financial problems, fiscal balance sheets in some state of disarray, and then think about the level of taxation. So this particular chart represents overall taxes, meaning from all sources: income taxes, sales taxes, property taxes, vehicle taxes, so on and so forth. And here you see that the gateway markets rank 45 out of 51 in total. In other words, you couldn't have a much higher or worse ranking for taxation. So one sort of paralyzing, threatening observation is the states with the worst balance sheets tend to be the states that have the highest taxes. That is not a sustainable situation. Next slide, please, Claire. So just as a subset of those taxes, I thought I'd dwell for a moment on property taxes, right? As real estate investors, obviously property taxes are near and dear to our heart. The lack of mobility, or say it the other way, the immobility of real estate also makes it a target for excessive taxation. Let me say it the other way. When we increase the income taxes, there's a chance that people leave our state. You can't pick up the real estate and move it. And that's what some politicians and economists look at when they think about trying to cure some of the fiscal problems that they have. And I skipped over one point that I should have probably made more directly in the prior slide, which is to say, when you look, Claire, if you could go back one slide, sorry to do this too. When you look at these tax rates, these are taxes on the median household income. There are 4 states, New York, New Jersey, Connecticut, and California, in which more than 40% of the state's total revenues come from the top 1% of wage earners via the income tax. That's another precarious position to find yourself in as an official who runs one of these states. Why? The most wealthy tend to have lots of choices as to where they can live and work. So Claire, if you could jump ahead 2 slides now, I'd appreciate it. There you go. A third factor amongst my 5 is the regulatory burden that the state, the city, or the county imposes upon its citizens and its companies, its firms. And so you can see in the dark shaded states, those are the states with the highest regulatory burdens. Again, the gateway markets far outstrip the non-gateway markets in terms of their burdensome regulations. And as we all know, right, the burdensome regulations tend to fall most heavily on the small companies. Big companies have the resources to navigate the legal labyrinth of regulation. It's the small companies that can't afford to do so. However, it's the small companies which tend to be the engines of growth in a market. So that's another problem, which I think many institutional investors have not focused on sufficiently with regard to forecasts of future growth and riskiness of those property investments. Next slide, please. So I apologize that this slide is hard to read, but this is where at least the first 2 of these factors come together for me. And so what I'm trying to show here is a ranking of the services provided by each of these cities by a third party, right? And you can just see by eyeballing and forget about the names for a second, those markets highlighted in blue represent the gateway markets. They're towards the bottom of the list. In other words, they provide the worst level of schooling, policing, infrastructure, cultural events, transportation, and all the rest. And this is where the rubber really meets the road for me. I think it's rational to think that some people might prefer a high tax, high spend state if the services rendered to the citizens were top notch. So if you want to contrast, for example, Illinois and Indiana, Illinois is a high tax, high spend state, but people in Illinois might decide rationally that it's worth paying the high taxes to have these superior services. Indiana, a low tax, low spend state, at least rationally might have less in the way of these services. But what's unsustainable and irrational in my view is to pay for more and more in terms of taxes, incur more and more in terms of indebtedness, and then end up with some of the worst services rendered to the citizens. And so one other point I want to just make in passing, when you have a quiet moment, if you ask for the slides, the last 4 columns to the right represent check marks associated with which group, tier 1, tier 2, and tier 3, these markets fall into. I don't want to make too much of it now. The next slide, please, Claire. And then my last factor is corruption. And again, if you're from Illinois, you know this all too well, right? And the old saying about power and corruption going hand in hand is quite evident, not only in Illinois, but in some of these other gateway markets as well. I would argue a corrupt political system, think about patronage, think about crony capitalism and all the rest, is a further inhibition with regard to the kind of growth that we would like to see at a base or fundamental level across the country, but we're not as likely to see in the gateway markets. And then Claire, if you jump to the next slide, please. So this spider slide or spider chart or spider graph is a little bit confusing, but think about this pentagon shaped display. On each of the corners of this pentagon are the 5 characteristics that I described a few minutes ago. I rescaled each one of those characteristics so that whatever the score is for the gateway market, it has been rescaled to 100. And then I looked at the tier 2 and tier 3 markets as a fraction of that 100-point value for whichever corner of this pentagon we're looking at. So it's obvious that the blue tier 2 markets lie well within the red pentagon shape of the gateway markets, and then the tier 3 markets lie even further away from the gateway markets. Both the tier 2 and the tier 3 markets representing instances where they are not as hidebound by these constraints as are the gateway markets. So I'm probably a little bit early on time, but I'm going to stop right there, and we can entertain questions. Dave, you can ask any question you like.
Oh, great. Joe, that was amazing. Thank you very much. And you actually only took 11 minutes. That was extraordinary. So I'm going to actually start with a question for you. And if you're not comfortable answering it, just so you know, Joe is constrained. He needs to be less predictive and more data driven than me. I can just sort of answer questions, just so you know. But I want to ask a question that's live, actually, just came in. And the reason I want to ask it, Joe, is I was thinking the same thing. And basically the question is, this is amazing research, and it confirms what he views or she views, it's anonymous, as consensus. And one, he wants to hear a bull case for gateway markets. What would you need to see to make them interesting? And I'm going to ask another question. And if you don't want to answer this, I can. But what isn't in your pentagon graph is the juxtaposition of pricing in the form of cap rates, right? And so when I'm looking at all that, that's all a demand function, and that's very interesting. But without pricing, you know, if I said to you, yeah, I agree, but there's a price I'm willing to take on lower growth, how would you also answer that?
Yeah, so let me start with the second one first. That's why I, in fact, started out with cap rates at the very beginning, right? Which is, you know, from a finance standpoint, it's all about whether or not we're being fairly compensated for the risk we're about to take. Another way to say that is, are the risk-adjusted rates of return appropriate or not? And my argument, fleshed out more in a paper that accompanies these slides, is that we need to think about the differential in growth rates, gateway markets versus non-gateway markets. We need to think about the ratio or the differential in the riskiness of those returns, gateway versus non-gateway markets, all balanced against today's pricing, as you rightfully point out. So, and I don't want to get out too far over my skis, but I understand that, for example, Detroit trades at a very high capitalization rate. You know what? It may be worth investing some dollars in Detroit. And again, I'm not advocating this, I'm just speculating this, that given the pricing, it's worthwhile thinking about those risks. My argument is that you're likely not getting paid for the risk you're taking in the gateway markets. And as an investment fiduciary, your politics notwithstanding, is that an appropriate deployment of your capital? It can, at a minimum, it concerns me. The first part of your question was something to do with what might be the impetus that turns things around for the gateway markets. I don't want to be overly bearish, but I don't see many positive signs on the horizon. There are not only the fiscal and regulatory problems that I talked about before, but in many of these gateway markets, there's also a bit of an anti-business sentiment. Without that changing, I'm not sure from a real estate standpoint that those markets are going to recover well. Having said all of that, if you're old like I am, you remember that in the early 70s, New York City went through a similar kind of malaise as today, right? Huge fiscal problems, crime-ridden streets, and all the rest. And New York came together, New Yorkers, I should say, came together and turned around the poor trajectory of the city. Could that happen in other places? I think on a smaller scale, I think Pittsburgh's another example of a turnaround in such a city. On the other hand, you have to think about Detroit, right? Once the country's 5th largest city, one of the country's most wealthy cities. And to go back to my earlier point, now well out of the mainstream of institutional capital and trading at what I understand to be extraordinarily high capitalization rates, reflecting the fact that Detroit never really recovered from its earlier fiscal problems, corruption, poor infrastructure, and all the rest.
Yeah. I'll address the capitalization rates a little bit. When Origin decided to not invest in gateways, this is 8-10 years ago, maybe more. It was because their capitalization rates were remarkably lower than the regionals. You call them tier 2 and tier 3, but these are the Dallases, Austins, Nashvilles, all the cities we're in. And so that was to me, a pretty easy decision. So we believe in higher growth in the regionals for all the reasons that Joe studied at a level that I didn't, but felt, right? In all seriousness, like everything he said, it's powerful because it's data and quantitative, but it's also you can relate to it. He didn't say one thing that you don't at some level relate to. And so we were saying, well, wait a minute, we get more growth with a higher cap rate or a higher entry yield. That's easy. Well, what's happened over the last 10 years is a steady decline of that spread. It used to be 4 in the gateways and 6 in the tier 2s and 3s, and then it was 4 versus 5. Now it's 4 versus 4, right? And it's flat. And if anything, it feels like it's going to invert. I will say in the gateways, and we haven't really covered this, Joe, but they're buoyed by international capital in a way that the tier 2 and the tier 3s aren't. And although that's a distortion, it's permanent. So like a distortion is really only a distortion if it's temporary. If it's always there, that's just reality, right?
Yeah.
And I can tell you, when you go to China or the Middle East, you know, and I've been there, they don't know what Nashville is. They don't know what Dallas is. They don't know what Charlotte is. And before you think that's short-sighted, name 6 cities in China. See how far you get. You know, it's just human nature. And then you don't want to invest in it because you've never heard of it. So, you know, I don't know when that changes, but would you agree, Joe, if that shoe drops and it becomes a more equal place, that could be another movement of capital?
Yeah, no, I think what you said is spot on, right? Which is to say that if you're an institutional investor, if you're a foreign investor, you naturally gravitate to the well-known cities for all the kinds of reasons that you mentioned. I will also say that the gateway markets historically, as I mentioned briefly in my remarks, have exhibited the most liquidity. So in a given year, by dollar volume, the gateway markets account for between 40 and 50% of US transaction volume. So particularly if you run a fund or you invest in deals that have a relatively short time horizon, the ability to get in, but equally to get out is a big factor, right? If you have a longer term view, then I would argue that this liquidity feature, which may be going away anyways, but let's assume that it sticks around for a moment or two, for more than a moment or two, is an important factor. The other thing I would say when I give this talk to practitioners, one of the pushback points is, well, you've ignored supply side constraints, right? Houston's kind of given as the typical example of, I'm going to exaggerate, flat as a pancake. You can build anything anywhere. They have no zoning codes. Again, I'm exaggerating to make my point, as opposed to San Francisco, this hilly peninsula, earthquake prone, jutting into the Pacific Ocean, right? And most of the coast has more rigorous building codes and entitlement processes than does sort of middle America. I think that's all true, but when I look at the numbers, what I really see happening is that supply in these gateway markets tends to go vertical, right? I build a bigger office building in San Francisco, in Manhattan, wherever. And so I think really that the supply side argument, and I need to research this more empirically, I think the supply side argument isn't as strong as the proponents of the gateway markets would have us believe.
Mm-hmm. And it's all driven by the cost of land. You have to build vertical to justify the prices of land in San Francisco, or and in Houston you can build horizontal. It's cheap land. I want to expand on what you're talking about, because I'll pose this question and you can answer me if you want. So you're absolutely right that the gateways are 50% of the volume historically every year. And you can go further. I mean, Manhattan itself is some unbelievably large amount of the total real estate volume in a given year. I don't want to misspeak, but it's a lot.
Yeah, I mean,
So,
think about a $1 billion office building in Manhattan. Not that
right,
unusual. Or at
doesn't
least
take a lot.
pre-pandemic, it wasn't that unusual.
So I'll bring it back to multi. So the agencies, Fannie Mae and Freddie Mac, they do an enormous amount of the lending and institutional multifamily.
Yep.
And one of the things that Origin has been doing for the last year is we're underwriting bonds because Freddie Mac in particular, when they make these loans, they package them into bonds, they sell the bonds. And we're looking at these bonds as potential investments. And I can tell you one thing that's amazing in relation to what we're talking about right now. The bonds don't have loans in the gateways. They're not there. And the reason they're not there is the pricing instability and what's happened with the demographic movements caused by COVID, people leaving cities, people leaving gateways. Lenders don't really want to lend to those cities, and owners don't want to sell at lower valuations. So there's just no transactions. They're not going into the bonds. And so, like, looking out forward, what I'm seeing is that is about to change. I think that next year we won't be able to sit here on this webinar and say, oh yeah, 50% of the volume is gateways. I don't believe that. I think it's going to be not just lower, it's going to be way lower.
Yeah. Well, let's assume you're right for a second. I could actually argue that's a point in favor of the gateway markets from this perspective. Most of these gateway markets, the last thing they need is a huge injection of new supply. Apartments or whatever property type you want to pick, right? So the fact that the lending markets are constraining probably both in terms of new construction deals as well as refis of existing or permanent loans might be a bit of a silver lining for some of these gateway markets.
All right, I'm going to take some of the emailed in questions. We still have 16 minutes. We're doing great. All right, no names here because they're all anonymous. If you did on the live questions, I might use your first name, but I would never use your last name. All right, Joe, do you want to have any interest, just chime in? What are the desired real estate asset classes in 2021?
Yeah, so you touched on this a little bit before, which I think is very interesting. The so-called digital forms of real estate, data centers, industrial to some degree, cell towers, think about life science buildings. It's not quite the same, but cold storage. All of these property types, as measured by the NAREIT index, have done exceedingly well over the COVID pandemic period. Whereas, as everybody knows, malls, office, retail, decimated. What really has me interested or kind of piques my curiosity is when you think about these forms of digital real estate, they almost have no people as tenants. In other words, a cell tower is a perfect example. Yes, there's a tenant, but there's no person in that structure, right? The data centers, the industrial properties, all true to a varying degree. And what has me sort of amused is all the kinds of things that architects and developers and engineers talk about, these kind of gauzy concepts of walkability and the built environment and all that kind of stuff doesn't seem to matter a hoot, at least during the pandemic, with regard to these digital property types. Now, I don't know if they're going to continue on their tear. Certainly, there's a lot of talk that industrial has been on a long, long run. Can it be sustained? I have no idea, but I do think it's interesting to note, at least during the pandemic, the property types that did the best had the fewest people as tenants.
They not only did the best, they had the least volatility. They didn't really go down much.
Yeah.
They recovered really quickly, and they continued to go up. And as a proxy for investing in technology, they're a great proxy. You should look into, I would challenge you to look into some of the returns on these tower stocks or industrial stocks, REITs, data center stocks over the last 3 or 5 years. It's not a one-year thing. They've done very, very well. Another thing I would add, Joe, is this notion of location in real estate, because you touched on this with walkability and features. It hasn't, it's still there. It's changed in its form. So with industrial, location matters, but it's location to ports, it's location to highways, it's location to rail, and it's location to last mile, right? And in terms of data centers, the location there is actually really important to the location to the primary power grid. Right. So location still matters, but the way that you come to that conclusion is very, very different than 10 years ago.
No doubt, right? I mean, retail's the opposite example, right? What we used to think was a great retail site from a locational perspective may be much less so today.
So I'm going to move on. Again, chime in if you feel comfortable. There's a question about retail, since we're talking about it. Thoughts on retail going forward. I would stay away from it. I'm able to say things like that. I don't think Joe is. I think generally think about how much consumption is online right now. I think it's definitely sub 15% at this point. And think about the carnage to get to 15%. And think about if you have kids, I do, they're not going to consume more physical real estate. It's going to be less. And their kids less than that. So like I just think you're in a massive negative growth market. You can win by buying cheap enough if you're doing it in physical real estate, or cheap enough in terms of retail REITs if you buy them cheap enough. That's not a great strategy that I like. That's not something that I would gravitate towards. That's my opinion on retail. The other thing I would add is think about what's happened with malls, just to hold them up. So your large big box, it's generally a dying industry, right? 5 years ago, it was JCPenney's poorly run, but man, Macy's is great. And their stock was on a tear. And now Macy's is fighting for survival, right? So what's happening is the malls were backfilling with what they call experiential retail. If you're in retail, you've heard this a lot. So look, people want to leave their house. They don't want to be on their phones. They're going to go to a restaurant. They're going to go to a bowling alley, whatever that experience is. Well, I would challenge you to think about the credits that you're investing in. The average restaurant certainly doesn't, what is it, less than 2 years? The average bowling alley, the average whatever. I mean, you're riddled with all these really awful credits. I don't want to be in that space.
Well, I'm sure I would add to your point about the restaurants and the like, these experiential entertainment type entities or venues. Generally, those companies ask for a huge amount of TIs and other rental concessions as an inducement into going into mall A or retail outlet A versus B. And so besides, or in addition to the credit problem that you described, as the owner of the building, you've advanced a huge amount of capital on a speculative non-credit tenant in a way that is different from, in your apartment buildings, you have non-credit tenants. In a hotel property, you have non-credit tenants. Yeah. But you're not spending the same kind of TI money and leasing commission dollars to get those non-credit tenants into your property.
Yeah, you're talking about high spend, low credit. That's a bad business model. Yeah. We just had a really cool question in on the live. It's a follow-up to this retail conversation. And the question is, yeah, but a lot of these malls are really well located and they can be repurposed. And by the way, that same thing applies to hotels. I can't tell you how many hotel deals I've been sent that can be, the business plan is to sell them to a firm like ours and we'll repurpose as apartments. Here's a challenge with that as a put, or like looking at as your sort of way out of an NAV that's dropping. It's very difficult to repurpose a mall into something else. It's very capital intensive. It's very difficult to repurpose a hotel into apartments. It's not impossible, but Origin or I have to buy it cheap enough to make sense and get my return on equity. And so you'll sell it, but probably not at the pricing you hope.
Yeah, I think it's interesting to think about hotels and malls in the following respect. Think about business-oriented hotels versus resort or destination-oriented hotels. I could make an argument that I'm much more comfortable with the future of destination or resort hotels than I am business-oriented. Think about sort of downtown, business-heavy, convention-heavy hotels. If it were my pocketbook, I'd rather bet on the resort hotel than the business-oriented hotel. I think there's an element of malls that fills that same kind of need or gap, which is to say that when you go to certain resort destinations, I think what some of the tourists do is they end up spending a portion of their day in one of the few remaining interesting malls left in these resort destinations. So my only point is, I'm just trying to make a very fine distinction. Maybe picking up pennies in front of the steamroller with regard to where that mall or hotel is located.
Absolutely, there'll be winners. In any negative growth industry, there's consolidation and winners, right? That's what you'll see in this space. Is consolidation, some winners in a negative growth environment. And so there'll be money to be made.
Yeah, no, I think it circles back to your earlier point about location. That's what really started to make me think about it, right? Which is to say, your comment earlier about location rekindled earlier thoughts I've had about hotels and malls.
So I'm gonna take some live questions. I apologize for those who emailed the questions prior. We just have too many. One of the live questions is about Chicago. And Joe, again, you can take this or I will, but the question is, won't we be seeing more people moving to the suburbs due to lower taxes, better services, some of the things you touched on in your presentation? It's predictive. I can take it if you don't want to.
Yeah, I'll start and you can jump in. I think you're already seeing it, right? I mean, I know lots of young professionals, particularly those with small families, who used to or live downtown or let's say in the city, and are tired of issues of rising uncertain property taxes, poor public schools, which is really another form of taxation, right? Meaning you have to send your child or children to a private school, issues of crime. And I don't care how nice your 1,500 square foot condominium is, you get tired of taking Junior up and down the elevator with his tricycle to the small park at the end of your block. And so this is a swept statement, a broad sweeping statement, excuse me. But yeah, do I think that a trend of people leaving Chicago for the suburbs continues? Yes. I think it's against the backdrop of, though, the Chicago market writ large, what some people call Chicagoland, faces a lot of fiscal pressures.
Yeah, first of all, people were in the suburbs and the city. They were moving from the suburbs to the city for the last 10 years. We talked about this earlier. When there's momentum, something has to stop it. And nothing was stopping it over the last 10 years. And then both people in the city and the suburbs were leaving just to leave. They weren't going from Winnetka to River North. They were going to Austin, right? That's still happening.
Yeah.
But what has changed is people are now moving from the city to the suburbs, and yes, also the suburbs to the city. That's happening nationally, by the way. Again, data's great. Also talk. We're in real estate, right? Talk to people who consume real estate. And I have lots of friends in New York City. The hottest market in New York City is Long Island. Why? It's a suburb, right? People are moving from Manhattan to Long Island. The home values are going nuts in Long Island.
Yeah.
That's a national trend. And by the way, predictive, I don't think it's going to stop. And the reason for it is we used to have to live where we worked. And if you didn't, you had to, everyone's doing calculus in their head, right? So, okay, I can live in Long Island, but man, it's an hour train, it's an hour and a half both ways. You're doing that math. Well, guess what? if you only have to go to the physical office 2 days now, because it's totally acceptable,
Right.
now it's much more attractive and less expensive. And to Joe's point earlier, you're getting better quality schools, all these things. I believe it's demand shift, and it's not a 1 year thing. I think there's an actual demand shift. By the way, a lot of the tier 2 and tier 3 cities, they're not really cities in the same way gateways are, right? If you go to Houston, Joe, I think you can relate to this. Where's the downtown Houston? It's everywhere, right? So like this notion of a city and a suburb is a very gateway-driven old city concept anyway, right?
No, go ahead. I'm sorry.
Yeah, go ahead.
No, I was going to agree with you, and I would just add one footnote to all this, which is as we spend more of our time in Zoom-like environments, we tend to need larger living facilities, right? You need a separate room, if not a home office, in a way that you didn't need prior to the COVID pandemic. And the suburbs generally provide that more easily than an urban location.
I'm going to move. I know there was a question I wanted to answer. We have I'm going to keep us on time. We only have 2 minutes left. This might be it. This question is, my son is a freshman in high school, and he said that he would like to go into the real estate space. I would appreciate information on education to get him started, education on the site, etc. Let me just start, and I think you probably have a lot of ideas, Joe, but one of the things that he can do, and really anyone on this webinar, Origin has an amazing library. We call it our education section, with over 300 articles or videos, and all of these have been written or filmed by our principals, me or Michael, or our senior people at the firm. And they're all about actual deals and things that we've learned through doing. And so and it's all sorted, by the way. So it's an amazing resource, and I'm really proud of it, and I hope that people use it.
Yeah, no, I think it's a great question. I think there's lots of dimensions to it with regard to the answer. So I think one of the things I would like to say is that there are many ways in which people can be successful in the real estate business, right? Not everybody has to be a fund manager. There are brokers, there are construction related jobs, there are all sorts of activities related to real estate. We know it's a high transaction cost business, and those people providing those transactional services are important. And so where you sort of self-select as to what's important to you and where your comparative advantage is something to be determined over time. I would say from a collegiate perspective, there are a number of well-known universities, many of them in the Midwest, that offer outstanding undergraduate real estate programs, and that's something that people should consider. I would say at the University of Chicago, from an undergrad standpoint, we don't offer real estate classes per se, but students are able to take classes in the business school. And I think one of the exciting things about real estate is it's still very entrepreneurial. So given all these different access points I talked about before, and the fact that it's still an entrepreneurial business, I think it's much more of a compelling industry than is viewed by some of our tech friends, right? Who tend to think of us as this dowdy, old-fashioned sticks and bricks kind of culture. So I'm obviously pro real estate for all sorts of biased reasons.
Yeah, and the amazing thing, I was telling this to my kids last night, when you learn fundamentally how to value real estate, you've also learned how to value any asset. Public stock, private equity, venture, it uses the same dialectic. There is no difference. It's just domain knowledge at that point. So whether you start in real estate or somewhere else, just know, if you say, I don't really understand real estate, but I know a lot about corporate finance, we could teach you how to value real estate in an hour, right? And then it's domain knowledge. What do you know about the asset class itself? That's wisdom. That takes longer. Last question, Joe, it's from me. When I went to University of Chicago booth, they told me when I was accepted, I needed to brush up on calculus. And so I was actually one of the students who did that.
Yep.
And then I didn't need it in any of my classes, but I didn't take the class because it wasn't offered to my cohort. I would have. Do you need calculus in Joe Pagliari's real estate finance?
You do not. No, I mean, we do look at, for example, some, I don't want to get too technical, continuous distributions, but we simplify the math greatly, and we try to extract the insight and the lesson to be learned.
Got it. Well, thank you so much. I really enjoyed the conversation. It was,
Likewise.
it was organic. We have about 60 questions we didn't answer. So for those who have questions, by the way, I'm happy to answer them. You can just email me directly. I am on our website, my email. So shoot me a note, and we'll follow up with the presentation and importantly, Joe's appendix. Thank you, Joe.
Thank you, David. Take care, everyone.